So it's late May 2026. The crypto market is just absolutely bleeding out.
Yeah, completely.
I mean, in just 9 days, we're talking a staggering $2 billion vanishing from Bitcoin and Ether ETFs. Just total panic.
Run to the exits.
Right. But right in the middle of that sea of red, there's this one underdog acting like a magnet for fresh capital. Okay, let's unpack this. For you listening, we've got a really fascinating stack of sources for today's deep dive.
We really do.
We're pulling market data from Sosa Value, CoinDesk, and Femex, specifically covering that super tumultuous window from May 20th to May 29th, 2026.
Right, that specific 9-day period.
Exactly. And we're pairing that raw data with some dense academic perspectives on ETF flows. Because the mission for us today is to figure out, is this massive divergence just a temporary blip, or are we, witnessing a fundamental rebellion against the crypto giants by smart money?
In a world of constant information overload, I'd say the most valuable skill you can have is spotting where the money is quietly moving, right? While everyone else is distracted by the noise.
Which they definitely were.
Oh, absolutely. The whole narrative during that late May window was just staring at the bleeding majors, the $2 billion running away. But under the surface, the architecture of institutional allocation was, it was quietly shifting in a completely different direction.
It's a massive contrast when you look at the numbers. Like, okay, over that 9 days, Bitcoin ETFs saw massive outflows, roughly $1.7 billion.
Yeah.
Ether ETFs lost about $309 million. But meanwhile, over in this other corner, the 7-spot XRP ETFs in the U.S., which, remember, only launched in like late 2025, early 2026, they raked in $35 million in net inflows.
Defying the trend entirely.
Right. And zooming out to the whole month of May 2026, XRP ETFs pulled in around $132 million. That pushed their total assets under management to roughly $1.12 billion. But wait, I have to play devil's advocate here for a second.
Go for it.
$35 million in inflows compared to $2 billion in outflows. I mean, isn't that just a drop in the bucket? Why are we making such a big deal out of this?
Yep.
Are we just inventing a narrative?
Yeah. Well, what's fascinating here is that it's not about the absolute dollar amount. It's the direction of the current. If you view it in a vacuum, yeah, $35 million across 7 ETFs is, it's pretty modest. But you have to look at the macro environment in late May 2026.
Risk off, right.
Heavy risk off. Treasury yields are rising. The U.S. dollar is showing immense strength. So Bitcoin and Ether ETFs are basically acting as an emergency exit for nervous investors. The algorithms are selling.
Just systematically de-risking.
Exactly. But amidst that exact same macro headwind, XRP is attracting patient capital. That's not retail throwing darts, that's calculated allocation against the current.
Okay, so that points to a huge narrative transition then. If this patient capital is actively choosing XRP while they're fleeing BTC and ETH, there's got to be a fundamental difference in how institutions view these assets right now. Like, what changed the risk calculus?
The absolute bedrock of this, the biggest driver, is post-resolution regulatory clarity.
The SEC versus Ripple saga.
Right. We're finally seeing the portfolio effects of that concluding. For years, compliance departments at massive hedge funds, they just blacklisted it. They couldn't touch it.
Too much legal baggage.
Yeah, institutions demand clean, unambiguous exposure to altcoins. Once that legal cloud lifted, it moved from the blacklist to the investable universe.
And we actually see this in our sources, too. There are these papers in the Journal of Financial Economics about ETF flows, and they show a really clear pattern.
Yeah, they do.
Sustained institutional adoption is rarely about, speculative hype or social media metrics. It's driven almost entirely by regulatory clarity and perceived utility.
They want the rulebook defined first.
Exactly. The defined rulebook and then a functional use case. And I love this analogy from our sources for the use case part. It makes it so relatable.
The cargo truck.
Yes. So if Bitcoin is digital gold, right, a store of value, and Ether is the world computer doing all the smart contracts, then XRP is essentially the efficient cargo truck of the traditional financial system.
I think that's spot on.
It's not as flashy as digital gold or a world computer, but it's doing the heavy lifting for cross-border payments.
And that perfectly illustrates what we call sector rotation. When the macro environment gets tough, institutions don't necessarily abandon crypto altogether. They rotate.
They move the money around.
Right. They move away from the mainstream, highly correlated assets into mature narratives that have, lower relative volatility. It's like Think of it like a party where the crowd gets tired of the loud mainstream DJ.
Okay, I like this.
And they all kind of migrate to a quiet corner with a more reliable underground vibe.
So XRP is the underground vibe corner of the party.
In late May 2026, it absolutely was.
But I mean, regulatory clarity only gets you in the door, right? You still have to prove you can actually haul the cargo.
Exactly. The ETF paper allocation doesn't mean anything if the network isn't doing the work. You have to examine the on-chain fundamentals.
Which brings us to on-demand liquidity, ODL.
Right. The real-world utility here is happening via daily volumes in ODL for remittances. To understand why this is a big deal to institutions, you have to look at how archaic traditional global finance actually is.
Oh man, the correspondent banking system.
Yes, the Nostro and Vostro accounts. It's Latin for ours and yours.
Yes.
If a U.S. bank wants to send a rapid payment to Mexico, they can't just beam dollars over and have them magically become pesos.
No, of course not.
They have to pre-fund a Nostro account with pesos at a Mexican partner bank.
Which means there are just trillions of dollars globally parked in these dormant accounts, doing literally nothing.
Just waiting there as lubricant for a trade that might happen tomorrow or next week. It is incredibly capital inefficient.
Trapped capital.
Exactly. And ODL uses the XRP ledger to replace that entire dormant structure. The originating bank just takes fiat, instantly converts it to XRP, sends it across the ledger in like 3 seconds for a fraction of a penny, and instantly converts it to pesos on the other end.
So no pre-funded accounts needed.
None. The capital is completely freed up. And when treasury yields spike, like they did in May 2026 when money gets expensive, freeing up dormant capital suddenly becomes incredibly attractive to allocators.
Wow, yeah, because holding dead money suddenly costs them way more in lost yield.
Exactly.
But again, if we want to know if this is a real trend, we need to see it on the ledger.
Yeah.
And our sources show that real-world utility was actually happening during this bloodbath.
Yeah, the daily ODL volumes stayed remarkably robust.
And the whales were buying, right?
They were. Recent reports showed significant accumulation by large-scale entities. While the retail algorithms were dumping BTC and ETH, high net worth wallets were just quietly absorbing the XRP supply.
Here's where it gets really interesting. That absorption totally reflected in the price. Despite $2 billion dragging the whole market down, XRP's price stayed incredibly stable.
It really did hold the line.
It traded in this super tight band between $1.30 and $1.46 during that whole tumultuous late May window. It actually climbed the market cap rankings just by refusing to fall with everybody else.
Just by treading water while everyone else was sinking.
Exactly. And the sources have this other analogy for this that I just have to share. The NFL analogy.
Oh, the tight end one.
Yes. Think of Bitcoin and Ether as these famous, highly paid superstar quarterbacks. When conditions are perfect, they throw these flashy, deep passes. But XRP is the reliable tight end.
The safety valve.
Right. When the team is under pressure, like a massive macro shock, the pocket is collapsing. The coaches aren't calling for a risky 50-yard bomb. They look to the tight end running a quiet, predictable route to just get the 5 yards and keep the drive alive.
I love that. And this raises an important question, though, because playing tight end in this market is incredibly competitive.
Oh, for sure.
XRP isn't the only network trying to be that high-speed cargo truck or that reliable tight end.
Who else is in the mix?
Well, you've got aggressive competitors like Solana and Hyperliquid. They are actively vying for those exact same institutional flows.
And they have serious tech, too.
Absolutely. They use different architectures, but they achieve similar high speeds and low costs. So XRP has to continuously prove its liquidity depth and uptime to defend that market share. A legal victory is a great moat, but tech moves fast.
Right. The market doesn't care about a lawsuit you won last year if your network is slow today.
Exactly. And the other massive risk is that crypto is still ultimately correlated to global risk.
The macro environment.
Right. XRP showed great relative strength holding that $1.32 or $1.46 band, but a truly massive macro shock, a huge liquidity crisis, could still drag it down. The tight end still gets tackled if the whole offensive line completely collapses.
Yeah, if the stadium loses power, nobody is scoring a touchdown.
Precisely.
So what does this all mean? For you listening, this isn't financial advice, obviously, but it is a massive lesson in how the 2026 crypto market is operating. We're seeing maturity. We're seeing real diversification.
The whole Bitcoin or nothing rule is completely dead.
It's dead. Smart capital is hunting for strong narratives, lower macro exposure, and proven on-chain utility. If XRP can maintain these inflows and hold its price resistances, it's really cementing itself as the premier institutional altcoin.
And there's one final thread here that we haven't pulled yet.
Oh, was that?
We spent this entire time talking about ETFs.
Right. The $35 million.
Right. But an ETF is essentially just TradFi's way of wrapping crypto in a familiar package so they don't have to deal with the tech.
Yeah, they just buy a ticker on a screen.
Exactly. But if XRP is genuinely the cargo truck of traditional finance, the real question isn't how many people buy the EPF wrapper.
Okay.
The question you should be asking yourself is, what happens to this entire space when major banks decide they don't want the ETF wrapper anymore?
Wow.
What happens when they just start plugging their own back-end infrastructure directly into the XRP ledger to settle those trillions in cross-border payments directly?
That wouldn't even show up on an ETF flowchart.
Not at all. But it would completely rewire the mechanics of global liquidity.
Man, that is a heavy concept to sit with. Direct integration. Well, thank you so much for joining us on this deep dive. Hopefully this helps you look past the panic in the headlines and, see the actual architecture of the market shifting.
Keep an eye on the smart money.
Exactly. Always stay curious, keep looking at the data, and we'll catch you next time.